Hello, good morning. Welcome, everyone. My name is Julia Dias Leite. I'm the CEO of CEBRI, the Brazilian Center for International Relations. And it's a great honor to have this partnership today between CEBRI and the China-Brazil Business Council, and have here with us one of the most important specialists on China, Arthur Kroeber, who is a director and a partner of Gavekal Dragonomics, and is a friend of CEBRI and the China-Brazil Business Council that it's been coming to Brazil in the last decade every year as usually in presence, but today we have him online. Thank you, Arthur, to be here. And also like to welcome Tatiana Prazeres, who's becoming also a specialist in China, is now based in Beijing, and is a professor and a senior fellow of International University of Business in Beijing. So welcome, Tatiana. Tatiana is now in Beijing. And also we have here Ambassador Castro Neves, who is a former ambassador in China and also a vice president of Emeritus of CEBRI, and as well the president of the China-Brazil Business Council. So I'll pass now to Ambassador to make also welcome remarks.
Thanks, Julia. It's a great pleasure for me to be a part of this event, jointly organized, as you said, by the Brazil-China Business Council and CEBRI, the Brazilian Center for International Relations. I'm proud to be a member of both institutions, actually. I would like also to thank Arthur Kroeber and Tatiana Prazeres for accepting our invitation and welcome all those who are with us today. I would also like to extend our best thanks and appreciation to our sponsors, Suzano and Plataforma Intacta to extend of Bayer. The title of Arthur Kroeber's presentation will be the plans of China for a new era of growth after the COVID plague, I would say. We were already living a world in transition. It has been some sort of a mantra of both CEBRI and CEBC. And the pandemics acted as a sort of catalyst of this transition. So things began to accelerate much more. And our great challenge now is try to outline what the world will be like after the pandemics. First of all, we must ensure ourselves that the pandemics will someday come to an end. But with that, I think Arthur Kroeber has been very attentive to those changes happening in China, what China will do after the pandemics, what the power structure of the world will look like, what are the negotiations or the dialogue between China and the United States, the two superpowers that we are seeing today, what they will produce, what they will bring about to the rest of the world, and how do we react to this rapidly changing situation. I won't extend myself much more, and I would give the floor to Arthur, thanking him once again, and also thanking Tatiana for their participation, Arthur and Tatiana. Arthur, please, you have the floor.
Okay, well, thank you very much for those kind words, Ambassador Castro Neves and Julia. It's great to be back here with all my old friends here from Brazil, and with Claudia Trevisan, who I first knew as a correspondent in Beijing years ago. So I'm only sorry that I can't be there in person to discuss these things more intimately, but that's the world we live in. Hopefully we'll be able to do that again next year. And I'm glad actually that although the circumstances are difficult, one advantage of this format is that it enables us to have an even wider audience than usual to discuss these rather complicated questions. So what I'm going to do today is spend, I hope, about 40 minutes to lay out some views on three broad topics. One is just understanding where the Chinese economy is going as we come out of COVID. So a little bit of a short-term view. Then I want to focus mainly on the medium and long-term objectives of Chinese development strategy, which relate to a very ambitious plan to upgrade national technology through very activist state intervention. And this is a plan that has been slowly gaining force over the last several years, and I think is now becoming much more crystallized and important. And then finally, I will talk a little bit about the US response to China's rise, its technological development plans, and how this response is changing under the Biden administration. And I think the short message there is that the Biden administration is essentially carrying forward the overall view of the China relationship that the Trump administration had, that the general framework is not changing, but some of the tactics and methods probably will change. And then I think we have time for a pretty good question and answer session. So now I just need to find my presentation, which is not showing up. So just give me a second. There we go. Okay. The title of my presentation is The Venture Capitalist State, and this refers to my view of the model that China is using to execute on its plans for technological upgrading. And it's a very interesting model that is a little bit different than I think anything that we've seen before in history among countries that have tried to have state-led technological upgrading plans. China has sort of innovated a new approach to this, and it'll be interesting to see how it plays out. But before I get to that, I'd like to set the scene by just describing where China sits economically a year or so after the COVID epidemic broke out. And the basic idea is that it's in a very strong position. If you go back in early 2020, February of last year, I remember having some conversations here in New York about people who were speculating that China's mishandling of the COVID epidemic in the early stages would be an event similar to the Chernobyl nuclear disaster in the Soviet Union in 1986, which was an event that exposed the weaknesses of the Soviet governance model and was a pretty important contributing factor to the collapse of the regime a few years later. I think we can now safely judge that this is not going to be China's Chernobyl by any means. In fact, China has been among the most successful countries in containing the epidemic. This has, I think, led to a massive increase in self-confidence within China, within the government and within the population as a whole. So the government certainly sees that it has done a much better job than other countries in containing this public health problem. The population, as far as I can tell, basically agrees with this. And so the regime has, if anything, more legitimacy and support than it did a year ago. I think the other key takeaway is that if you look at the path of China's recovery from the COVID-induced economic crisis, number one, it has been faster and more robust than any other economic recovery in the world. And this is the second time in the last 15 years that China has achieved this. Back in 2008, 2009, after the global financial crisis, again, China was able to come out of the crisis more quickly and in a stronger position than any other major economy. So again, I think this leads the government to think that they have a pretty good economic system that is not only able to generate high growth, but is also very resilient when you get an unexpected shock like a financial crisis or a pandemic. However, there are a couple of key differences between this recovery and the 2008 recovery, which are worth noting. The first is that you probably recall that China's growth after the global financial crisis was driven by massive fiscal and monetary stimulus, a huge increase in debt, massive infrastructure spending, and this was, among other things, very beneficial for commodity prices. And we had a couple of smaller cycles later on where there was a similar playbook, and China responded to an economic downturn by big increases in credit and leverage. This time that did not happen. There was an increase in credit, there was an increase in leverage, but China stimulated its economy much less than the US or Europe, both in fiscal and monetary terms. And the stimulus was much smaller than any of the last 3 or 4 stimuluses in China's history. So both with respect to its own history and compared to the rest of the world, China did much less stimulus and yet achieved a better result. So again, this is, I think, seen as validation of the success of the Chinese system. The other thing is that Chinese exports in 2008 basically followed the global pattern. This time they massively outperformed, and this is, I think, a testament to the breadth and the resilience of China's export sector. So all in all, it's a very positive situation. And I think looking ahead, we and most other economists expect that China will grow, by 8 or 9% this year. A lot of that is base effects. But even if you strip those out, by the end of the year, I think China will be growing at an annual trend rate of something more than 5%, which is lower than they've had in the past, but it's still much stronger than any other major economy in the world. So it's a strong position. Just a few charts to illustrate this. And I'm sorry, I decided to include Brazil on this chart just for reference. I don't think I have to tell you that things are really problematic there, but I think this illustrates the way in which China has really had a very different pandemic than other countries, both in the developed world and in the developing world. So you can see the black line there at the beginning in February shows the peak number of deaths in China. They may have understated the totals a little bit, but I don't think substantially. And clearly there has been, none of these secondary waves that we've seen in other countries. And I was back in Beijing for a couple of months between November and January. We traveled around the country a bit, and indeed, I can testify that life is basically back to normal in China. There's more mask wearing, but most activities, generally speaking, are normal, which is very different than the rest of the world. This is the pace of its economic recovery. You can see that they had a very sharp slowdown in the first quarter, but then a very quick bounce back. They were in positive growth by the second quarter and significantly outperforming the rest of the world by the end of the year. And I think that outperformance probably is going to continue for another quarter or two until the US and Europe are more fully vaccinated. This illustrates the credit, the change in credit, and you can see China did increase its bank loans pretty significantly. There was a pretty significant acceleration in credit growth, but compared to the huge outlays of both fiscal spending and bank credit in Europe, the US, and Japan, China's stimulus looks pretty small. So again, the point is they achieved a very strong economic recovery at the price of a relatively small stimulus. If we look at the key sector of the economy that is still central and I think important to a lot of people in Brazil, one of the reasons that the economic recovery was so quick was that the property sector was very, very robust. You can see these are indicators of sales and construction and property. They fell quite a lot in January and February, and then they bounced back to really extraordinarily high levels. And this has led to a big increase in demand for materials, including steel. Long run, we think that the property market in China is, at its peak, and will, have a declining contribution to GDP in the coming several years. But in the short run, it's been a strong contributor to growth, and we see that, I think, continuing through this year. I throw up this long-term slide on housing demand, which shows. This is our model here on the left of housing construction growth. And basically, we have different assumptions, and it's a little bit difficult to know. But broadly speaking, we believe that China has hit the peak of its long-run housing demand. It is now on a plateau, and it probably will decline in future. And this here just shows the contribution of the property sector to GDP. And what this really stands in for is a broader idea that the traditional sources of growth in China, from housing, from infrastructure, and from this, intensive capital spending on physical stuff, these growth drivers are coming to their end. So China needs a new set of growth drivers, and that is one of the reasons that they have this technology-driven strategy. And so really, I think the technology-driven strategy, or what they call the innovation-driven development strategy, or IDDS in China, it kind of comes from two sources. So one source, as I've said, is that the things that have driven the Chinese economy for the last 20 years, particularly housing and infrastructure, they are not going to be the growth drivers of the 2020s. It's just not possible. So if you want to keep growing by 5+%, which I think they do, you have to have something else. And in the minds of the Chinese planners, this something else is massive technological upgrading. I think there has been an additional spur to this strategy because of the trade war with the United States over the last 3 years, which turned into kind of a technology war. It started with Trump's tariffs, and then very quickly it became the US putting export controls on high technology goods, particularly semiconductors, going to China, and targeting specific Chinese companies, notably Huawei, and trying to really cripple them. So China, number one, knows that it needs new growth drivers. And number two, it knows that it needs to essentially achieve technological independence from the United States. Otherwise, the United States will always be able to constrain their growth. And, if we step back and think about sort of the larger way that the Communist Party thinks about the economy, we can see these strategies that I've highlighted here on this slide sort of give a picture of their thinking. So one is this strategy of dual circulation, which was announced last May, which it's kind of a hard to understand term, but fundamentally it's a simple concept. Dual circulation just means there is economic circulation that occurs outside the country. So this is essentially the export, international capital flows and so forth. And then there's the domestic economy. And what the Chinese are saying is, we want to continue having an active export sector. We want to continue participating in the global economy, but we know this is going to be much more difficult because the US, instead of being helpful, as it was for most of the last 40 years, is now really much more adversarial. So our access to global markets probably will be constrained a little bit. Therefore, we need to have a more resilient domestic economy. And then when they think about resilient domestic economy, I think a lot of us in the economics world would say, oh, well, what that means is you want to stimulate consumption. And there's been a lot of discussion in China over the last 10 years about shifting from investment to consumption. And I think a key thing to understand is that that is really not what the Chinese government has in mind. They don't, that's not how they see economic growth. They see that consumption comes as the result of investments in sectors that generate productivity growth. So instead of shifting from investment to consumption, what they're proposing to do is shifting from investment in housing and infrastructure to investment in high technology sectors. So it is fundamentally a supply side driven policy. It is not a demand side driven policy. And that's just how they're going to do it. And their conception of how they do it is a little bit innovative because they're not going back to the days of central planning. This is not sort of a return to Maoism or complete top-down control of the economy. They want to have a large private sector, but they believe that the state has a guiding role. And the metaphor that I use to describe this is sort of that the Chinese government sees itself as running a giant venture capital fund, where the government or the state is the general partner that decides where the main investments go, and it provides some of the initial funding, But then a lot of the other funding comes from limited partners who are individual state-owned enterprises, domestic private investors, the capital markets, foreign companies, anyone who wants to get a piece of the action, basically. And so the state's role is not to dictate everything, but to identify the broad opportunities and to mobilize a diverse set of funds to go into these sectors. And the theory is that even if some of these bets don't pay off, enough of them will that they will pay for the losers. So again, it's like a venture capitalist who knows that if they invest in 20 startups, 15 of them may not do very much that's interesting. 3 or 4 will be pretty successful, and hopefully 1 or 2 will be gigantically successful. And so the smaller number of successes will pay for the larger number of failures. So let me just drill down into this in a little bit more detail. So here we have a sort of an explanation of China's sense of its vulnerability on technology. And what you can see here is on this chart, these are the key technology items that China imports each year. As you can see, semiconductors in red, aircraft, and pharmaceutical and optical products. And you can see that this has steadily risen over time, and particularly semiconductors. China's imports of semiconductors now exceed their imports of crude oil. It's their single biggest import item. And a lot of this either comes from the United States or from countries that are in the United States sort of strategic orbit. It became very evident in the Trump administration that this dependency was a problem, because the United States put in place these new laws that restrict foreign direct investment, restrict exports. They also made use of this tool called the Entity List, which allows the US government to target certain foreign companies for export controls. And so basically, you have a whole series of actions by the United States to restrict the flows of high technology to China in general, and to China's top companies in particular. And then just before the Trump administration left office at the end of last year, Congress passed what's called the Holding Foreign Companies Accountable Act, which effectively means that Chinese companies that are listed on in US stock exchanges, they will have to leave the US stock exchanges within 3 years unless they can comply with US audit regulations, which they can't because Chinese law basically prevents them from doing so. So at the end of the day, they'll be able to relist in Hong Kong. So this is more of an inconvenience than anything else. But again, I think it signals that the aim of US policy is to restrict technology and financial flows to Chinese companies. And so therefore, China needs to have a strategy for developing technological self-sufficiency and making sure that it can mobilize domestic funding that is sufficient to build up its technology industries. They can't rely necessarily on funding from the United States anymore. So a lot of this, frankly, relates to semiconductors. We could talk about many products, but semiconductors go into all of them. And what is noteworthy here is that China's reliance on imported semiconductors really has not gone down. They've had a very active program of support for the semiconductor industry for several years, but it has not reduced the import reliance. About 2/3 of the semiconductors that are used in Chinese industry still have to be imported. And they're mostly imported from Taiwan, Japan, Korea, the United States, Singapore, all countries that are in some kind of formal or informal alliance relationship with the United States. So this is clearly a point of vulnerability. Even more significant for their plans is that the tools to make semiconductors, which are very specialized, 100% imported. And you can see that these come principally from Japan, the United States, Korea, a few other countries. Again, all from kind of the US alliance network. So China is quite dependent on these critical building blocks of the technological economy. And so they are really determined to build their own capacities. So how are they going to do this? Well, so I've introduced this concept of the venture capital state, and the sort of the first way that this works is that the government over the last several years has set up a series of what they call industrial guidance funds. And these are funds set up either at the national or at the provincial or at the city level to fund specific industries. The two biggest ones are the National Integrated Circuit Fund for semiconductors, and there's another one called the National Strategic and Emerging Industries Fund, which funds a broader range of industries that the government has defined as strategic. So this would include new energy, electric vehicles, artificial intelligence, robotics, new materials, and so forth. And one of the problems that we have in analyzing this is figuring out how much money is actually in these funds. Because if you go around and add up all of the amounts that they claim that they're going to raise, you come up with a figure of about 1.6 trillion US dollars, or 6% of GDP. I don't think that that is a real number. You know, when we did spot checks on this a few years ago, we found that number one, a lot of these funds had not raised any money yet. They said, well, we're going to raise, you know, 100 billion renminbi, but they actually had zero in the bank. And the other is that particularly at the local level, many of these funds are identified as industrial funds, but they just become another way to fund, you know, infrastructure and real estate investments, right? So the total amount of funding here, I think, is very, very difficult to ascertain. But again, I come back to semiconductors because this is where we have the best information. And we do know for a fact that the national funds have raised $50 billion. Some city funds have raised probably another 20 or 30 billion dollars. And this has gone into massive investments over the last 4 or 5 years in a number of semiconductor fabs that you can see and that are actually producing. So part of the funding strategy is just these state mobilized funds. But the other objective of the government is to sort of identify these sectors as important and then encourage capital markets to play a big role. And if you look at, and I'll show you some data on this in a minute, if you look at what's going on in the Chinese equity and bond markets, a lot of the money that is being raised in IPOs and secondary offerings in the stock and bond markets is now going into these strategic industries identified by the state. So it's not just the state putting its own money in, it is also the state signaling to the private sector, these are important sectors, please invest in them. And that basically is what happens. I think there are two other key components to this strategy. One is there's a lot of talk now about improving the funding for research and development in China, and particularly for basic research. China has increased its R&D funding over the last 20 years by quite a lot, but most of this has gone into applications and sort of late stage R&D. Government funding for basic research is still a relatively small part of the pie, and there's now a push to increase that. And then the other part is that although this is a strategy designed for self-sufficiency, it also involves a strategy for bringing foreign companies in. So they're not closing the doors. In fact, they're opening the doors wider because they realize that they need foreign company expertise to help drive this technological innovation. So this creates, I think, an interesting dilemma for all countries, but particularly the United States. The governments will typically say, well, we don't like what China's up to because they're trying to create essentially domestic substitutes for our companies, and China's trying to build up its power in a way that will threaten our national security. But the companies themselves often say, well, yes, we see those problems, but China is a huge market and they're actually making it easier for us to operate there, so we can't afford not to be there. So there's a tension between the national security interests and the business interests, which is very difficult to resolve. And I guess the final point I would make on this is that, you know, I think we're all familiar with past instances of industrial policy. You know, in Brazil, you have your own history going back to the 50s and 60s of developing, you know, state-owned enterprises in key industries. We also saw efforts in Japan, South Korea, Taiwan, from the 50s through the 90s to have state support of major companies. But the scale and scope of what China is doing is far greater than any of these previous plans, right? It's a little bit like previous industrial policy, but it's also much grander in its conception. And it relies much more on direct funding by the state. So really, there is no precedent for this in any other country that I'm aware of. I won't go through all of this. I should add, I've given the presentation to both the people at CEBRI and CBC. If anyone wants it, just send in a request, and it's, this is a public presentation, so you're welcome to have it. The point here is simply that there's been a 15-year history of science and technology development plans in China that have sort of crystallized in this venture capitalist state model. This is not something that was invented 1 or 2 years ago as a response to the trade war. This has been slowly developing over time in the Chinese system. And I think its development has just been accelerated a little bit by the trade war. I have some material here on the role of the state sector, which I'm going to skip over. We can get back to that. What I do want to emphasize, though, is some of the diversity of the funding. So again, as we talk about this venture capitalist state, a lot of the focus, as it should be, is on the state-led investment. But it's also important to understand that companies are, in many cases, independent actors, and they're doing their own thing. This is our analysis of R&D spending. And you can see that the government funding for R&D actually has not risen all that much in absolute terms. The corporate share is actually what's been driving R&D growth. So this is not just the state coming in and saying, we'll do this and that. It is now a very highly developed corporate sector in China that is investing its own money in R&D and is getting supplements from the state. This is what I mentioned in terms of the capital markets. You can see this is total funding to strategic industries as indicated by the government. And what we can see here is this gray line shows that this is the share of total equity and debt raising in Chinese capital markets that goes to these strategic industries. And you can see last year was about 36% of all new capital raised in the capital markets in China went to these strategic industries. And you can see the direct subsidies by the state to these companies is actually pretty small. Most of it is equity, which is what you see in red, or debt, which is a combination of bank loans and bonds. So again, it's not just the state taking budgetary funds and pouring it into companies. It is the state sending a directional signal and then capital markets responding to this signal. Within the strategic sectors, you can see that information technology is by far the biggest recipient. Most of this is semiconductors, right? And then we see these other sectors are in there as well. But semiconductors and IT really are the main focus of activity right now. And if you look at listed companies and where they're putting their investment expenditure, this is total CapEx and R&D spending by listed firms in China. You can see that now 40 to 45% of all CapEx by listed firms in China is in these 10 strategic emerging industries that the government has invested. So again, the signal has gone through very loud and clear that if you're in the private sector, you want to invest, the best place to invest is in these strategic technology sectors, right? So I want to start shifting the focus of my comments now to how this relates to the rest of the world, right? Because I think what we've seen is that governments in the United States and increasingly in Europe have started to pay attention to China's industrial policy drive. They've become very concerned because they see that China is pouring huge amounts of money into companies that could compete with incumbents in the United States and Europe. they don't see it as a level playing field. So this is a problem. And there's also concern, particularly in the United States, that China is catching up with and may even surpass the US in total technology, right? And so I think the first point I want to make here by showing this slide is, this chart really shows two things. So this is just a measure of total expenditure on R&D. So you can see that China's technology R&D spending has risen very rapidly. It's now much bigger than Japan and Germany. It's catching up with the United States. But if you compare China to the entire OECD universe, it's still a lot smaller, right? And I think this is very important because often the debate about China is couched as, oh, it's a US versus a China thing. But actually, I think this technological competition is more about China on the one hand and the universe of mainly Western democracies for which the OECD is a shorthand on the other, right? And this is important because I think the Trump administration had a view that the way for the US to respond to China was essentially a one-on-one battle, right? And so they had a very unilateral policy. The Biden administration, I think more sensibly says, no, actually China's pretty big. And so the United States needs to work with its allies. And that has been the focus of a lot of the Biden administration activities so far, is to shore up the relationships with allies and find ways that they can work together to counteract the rising influence of China. And so if you look at R&D spending as kind of a proxy for the balance of power, if you will, you can see that if the United States, wants to go one-on-one with China, it's pretty close. But if you have a broader coalition of countries, the US, Europe, Japan, and so forth, that have common interests in contesting China's industrial policies, you have a better chance of success. So I think this is the basic framework that the Biden administration is working with. Okay, so these are just a couple of charts to indicate how much China is putting into semiconductors specifically. This is the monthly production of semiconductors by volume. You can see it's really ratcheted up in the last few years. China now is spending more on semiconductor investments than any other country in the world. This is the cumulative over the last 4 years. You can see they've put in $60 billion. There's more to come. So we're definitely going to see more and more investment by China in these sectors. This is a chart that illustrates the point I made earlier about how investment restrictions on foreign companies are actually reducing in China. They're actively seeking investment by many different types of companies, particularly in fields like finance and biotech. So again, China has this industrial policy. It's focused on domestic self-sufficiency, but it doesn't mean that they're closing the door to foreign companies. Quite the opposite. Okay. Let me just, I have a few minutes left, and I want to focus on basically the US response. But before I get to that, I want to just throw out some food for thought on, okay, we know that China has this massive industrial policy ambition. Will it work, right? And I think the answer is we just don't know. And we have some reasons to think, yeah, maybe it will work in some areas, but we also have some reasons to think that maybe it won't work. So I've thrown up some examples here of, if you look at China's industrial policy of the past, they have had some successes, right? So they developed very strong companies in telecoms network equipment. They basically have taken over the global high-speed train market, and they've been very successful at new energy, solar panels and wind turbines and so forth. So there are some areas where Chinese industrial policy has worked quite well. There are others where it's just not worked at all. So they have not created globally competitive automobile manufacturers. They've tried for years to create an aircraft manufacturer, and they're creeping towards it, but most people, I think, don't think they're going to be very successful. And they spent 20 years trying to build a semiconductor industry, and so far it hasn't worked. So I think that's question number one, is we shouldn't assume that just because China has all of these ambitions that they will succeed. I think they may succeed in some areas. They will almost certainly fail in other areas. And so we need to be a little bit careful about getting too panicky about how Chinese companies are going to take over the world in every single sector. I don't think that's going to happen. The second thing is, I think, what does success mean for other countries, right? Is it good or bad? And I think it's complicated, right? So for example, there's a very active discussion right now in the United States about the solar industry in particular, right? You have some people who say, China subsidized its solar panel makers. They drove all of our solar panel makers out of business. This was a terrible thing. So we don't like China's solar subsidies and their industrial policy that destroyed our solar industry. But then you go across the street and talk to people who are talking about climate change, and they say, oh, it's great that China did all this stuff because now the price of solar panels is like 5% of what it was 5 years ago. It's so much cheaper to transform our power grid into a renewable grid because of cheaper products from China, right? So that there's a clear negative for US industry, but there's also a clear positive for global energy transformation from these policies. So which is more important? Hard to say. Similarly, there's a discussion going on about semiconductors. One side says, oh, it's terrible that China's investing all of these things. It will drive our companies out of business. And it will also crowd out innovation because it will drive prices down. That means the established companies will have less money to invest in R&D, and so innovation will slow down. But there's another school of thought that says, well, if China makes certain kinds of semiconductors cheaper, then because semiconductors are an input into other innovation processes, you get faster innovation somewhere else. So again, is China's massive investments in making technology products cheaper, who is this good for? Who is this bad for? I think the answer is it's complicated. Now, if we look more specifically, though, at the political situation in the United States, I think there is a very clear overall perspective that the whole Chinese drive for increased technological upgrading is bad for the United States. Okay, this is essentially accepted by everyone in Washington. And so what I've tried to do here is to create a map of the interest groups, the politicians, and the policy outcomes that we can expect in the United States as regards China policy. And I think the generalization here is that Trump's basic achievement was to shift the framework of US policy towards China away from what we used to call constructive engagement to strategic competition. Or another way of putting this is that up until about 2016, broadly speaking, the US saw that China's economic growth was a good thing, and they tried to help it in various ways. And now, broadly speaking, the US thinks that China's economic growth is not such a good thing, and they see China just as a competitor. And the Biden administration has made it very clear that they agree with that shift. Okay, no more constructive engagement. We are in a competition with China. The only issue is, how do we compete, right? And the Biden folks are saying, we have a much smarter idea of how to compete than Trump does, which may or may not be true. But I think what that reflects is that Biden is responding to a broader range of interest groups. Okay, so if you look here on the left, Trump basically was representing two interest groups. Number one was economic nationalists who wanted to bring manufacturing back to the United States and who wanted to act unilaterally, not in concert with allies. And the national security state that saw China's rise as a military and security threat, and they wanted to push back against it, right? And there was some tension between these two things because the economic nationalists did not want to work with allies, and the national security state does want to work with allies, but they both saw China as a big problem, right? So Trump basically played to these two constituencies. He pretty much ignored the business interests, and he definitely ignored the human rights people, right? He wasn't interested in those issues. What Biden is trying to do is say, let's come up with a strategic policy towards China that caters to all four of these interests, right? Yes, we want to bring back manufacturing to the US, and that's a lot of what his so-called Build Back Better infrastructure program is about. Yes, we want to protect US national security, absolutely, and so we're going to keep the technological and financial controls on China in place. But we also have to recognize that business interests in the United States, US companies in China are enormous. And it's important for US technology companies to keep selling to China because it's one of their biggest markets. And the revenues from China are what funds their R&D and what enables them to build new and innovative products for the private sector in the US, but also for the US military. So we have to recognize that there are legitimate business interests in continuing to engage with China. And we also take human rights seriously. So we're going to take a hard line against political repression in Xinjiang or Hong Kong or whatever. And this is going to be a much bigger part of our picture. So the problem is, and finally, the other big piece of it is that unlike Trump, we're going to work with allies. So we're going to cater to all of these different constituencies, and we're going to try and find common ground with allies. So I think this is all very rational. It's very idealistic, if you will. It's also very hard because the more different interest groups you bring in, the more complicated it is. And the more partners you try to work with, the more complicated it is. So I think the bottom line here is, number one, US-China strategic rivalry is here to stay. Most of the Trump era restrictions on trade, technology, finance, and so forth are going to be permanent. Biden is not going to take them away. He may be more pragmatic in negotiating with the Chinese on specific trade issues and on things like climate. So there will be some more openings there, but I think not a lot. I think what we're looking towards is a US policy that is going to be more strategic than under Trump, more disciplined, focused on trying to reduce somewhat the interdependence of the US and Chinese economies. But there's only so far they can go because these economies are very closely tied together. And I want to leave you just with a couple of charts that illustrate how difficult this is. This is a chart that shows US economic relationship with China. If you look at the black line here, this is how much US exports to China each year. So it's not a bad number. It was almost 200 billion in 2017 before the trade war. The blue line shows how much US companies sell from their domestic operations inside China. And it's almost $600 billion a year. So it's basically 3 to 4 times higher than the export volumes. US companies have enormous positions within China. For most companies, it is either their biggest market or their fastest growing market, and they don't see that they can go away. And in fact, if you do a poll of US companies, as the chambers of commerce do every year, say, do you have plans to move out of China? The answer is still overwhelmingly no. 85 to 90% of companies, despite trade wars and all of these other things, say we can't afford to leave. There's only a small percentage of companies that are planning to leave. So it's really very difficult to have what you could call a full decoupling of the two economies. So we're left with this position where the US and China, I think, are locked in a much more intense strategic rivalry. This will continue, I think, and grow under the Biden years. It will be, I think, a little less unpredictable than under Trump, but it will still be a big feature of the landscape. But this rivalry is severely constrained by the fact that US companies and European companies and other companies feel that they have to be in China. They have no other choice. I think I will leave it there. I've hopefully given you some good food for thought. I noticed that there seem to be some questions coming into the Q&A box, so I think we'll have a lot to talk about, but I think I will stop sharing my presentation now and then hand it over to Tatiana.
Thank you very much, Arthur. We have about 500 people live with us, and it's having a lot of questions. I would like to say that the presentation, as Arthur said, is public, and CEBRI and CBBC will send a link to everyone. Okay, so Tatiana selected some pass to her to conduct the debate. We have half an hour. Tatiana.
Excellent. Well, thank you very much, Julia. Arthur, thank you for the excellent, super insightful presentation. Let me say that I follow your work for some years now, and I was delighted when CEBC and CEBRI approached me to moderate this session. It's an honor, it's a pleasure really to do this. And well, as a moderator, maybe I can, I have some exorbitant privilege here to maybe ask you the first couple of questions. And there are many interesting questions, so I try to be fast here. Arthur, your insight about this venture capitalist model is very interesting. And of course, all your research about the Chinese industrial policy is very, I mean, it gives a lot of food for thought, I would say. And by listening to you, many Brazilians may be tempted to believe that, well, a similar approach could potentially be interesting for Brazil as well. Of course, I'm not talking about the scale, but the design of the Chinese approach. So how would you react to that? Are there any lessons that other countries could draw from the Chinese venture capitalist state? And what are the risks, right? I feel like it's very challenging for a country like Brazil, whose experiences in industrial policies are not, I mean, that successful, to say the least. But at the same time, they will be competing, Brazilian companies will be competing with Chinese companies. So, I mean, it's like being between a rock and a hard place here. What are your thoughts on that?
Yeah, that's a good question. So first, I mean, I think the risks of this approach are very clear. The risk is that you waste huge amounts of money because you're just pumping too much money too quickly into the economy. There isn't enough market discipline. We already have some examples of that. So in the semiconductor space, China has poured all of this money into fabs. So two of them, each with about $5 billion in state investment, have already ceased to function, right? One of them because it stole its intellectual property from a US company. The US was able to document it and they put export controls on it that prevented it from installing the equipment. That was Fujian Jinhua. The other was just a case of plain fraud, right? So some guys get together, they didn't know anything about semiconductors, but they saw that the government was handing out huge amounts of money for semiconductors. And so they set up this company in Wuhan, I think it was, and they claimed it was a semiconductor company, and they collected several $1 billion of government money, and they never had a plan, right? And they sort of built a fab, but it didn't work. It wasn't even big enough for the machines. It was a complete scam. And so that has had to shut down, and several $1 billion again have been wasted. So I think this is really the number one risk in China or anywhere else of just like massive funding in a short time for industries is that you attract a lot of questionable people, right? And so that I think is a major problem. As I said, it's not at all clear that any of this will work. And when we look at I guess the observation that I would make is if you look at the history of industrial development after World War II in many countries, particularly in East Asia, the success of these countries was not so much that they were brilliant at picking winners. It was that they had mechanisms for getting rid of the losers, right? So for example, in Japan and Korea, they had basically export quotas. So if you succeed in exporting enough, then you would continue getting access to credit. If you didn't get enough exports, then you lost your access to credit. And so the companies that were not globally competitive basically went out of business, right? And so this ability to get rid of the losers is really important. And one of the problems that I see in China is that because essentially the state is mobilizing such a high proportion of the funds, and the state has an informal rule that if you're a state company, you can't go bankrupt. I don't see a mechanism for getting rid of the losers in the system. And that's likely to create a lot of inefficiencies. So I would say, no, this is definitely not a model that anyone else should try to copy. also because I think a lot of it depends on just having the particular political construction that China has with the Communist Party and the ability to mobilize all of these state-owned enterprises who can chip in money and et cetera, et cetera. There's so many things that are peculiar to China about this. And I think for most countries, the lesson has been, and Brazil is a great example of this, is that import substitution policies generally do not work. And it is better to have a somewhat more liberal environment that particularly is focused on international competitiveness and more market mechanisms. So I think this is something where other countries should look at what China is doing with interest, try to figure out if things do seem to be working, why are they working, and maybe there's some specific lessons you can learn. But as a general model, I think this is a very high risk one, and it might be able to somewhat work in China. It's very unlikely that it would work anywhere else.
Excellent. Thank you very much. Let me ask you a second question related to the US-China rivalry in technology, in the digital economy, and the implications of that. So how much and what kind of decoupling do you expect to see over the next 4 years, this next political cycle in the US? Many refer to a bifurcation of the digital economy, of a splinter net maybe. Do you see this happening, and what would that mean for the rest of the world?
Yeah, a good question and a little difficult to answer. So first of all, if you look at the so-called splinter net, and that's already occurred, right? China essentially decided many years ago that it wanted to have its own internet with its own rules, without Google, Facebook, all of these other countries, and with heavy censorship controls. They, imposed that, over 10 years ago, and that's what we have. So there's a Chinese internet, and there's the rest of the world internet. Now, are we going to have separate, sovereign internets for every major country? I don't think so, right? I mean, I think, a lot of countries are figuring out better ways to regulate their internet economies at the margin. But fundamentally, I think we're going to see a landscape where there is, the same that we have now, that there is a global internet with some local restrictions here and there. And a Chinese internet that is distinct and walled off. And we're living with that now, right? When we talk about sort of technological decoupling, and here I think we're talking about the hardware side of things, that's tough. It's really tough. I think what we're going to see is, because as I indicated, for most foreign international companies, China is a really important market and they can't go away. And the US government, if you look at semiconductors, the US government says, oh, it's really terrible that China has all these semiconductor investments and we need to stop them. And you, American semiconductor companies, should not be selling to China. The semiconductor companies are all saying, no, we have to sell to China. It's our big market, right? Please don't make us stop selling to China. And so they've been real opponents of these technology controls because China is such an important market, right? Mm-hmm. So that has shown, I think, some of the limits of decoupling is that you just can't. Now, what I think is beginning to happen is, and you see this very clearly in the Biden administration, is they say, okay, we should probably focus less on technological controls. We should focus less on reducing flows of technology to China. And we should focus more on building up our own domestic economy, right? Mm-hmm. So what you have seen is, number one, TSMC, the big Taiwanese semiconductor maker, is building a gigantic fab in Arizona. Intel has announced that it's going to build 2 big fabs, $10 billion each, in Arizona. Biden is going to release his big infrastructure plan, and I think in a day or so. And the focus of this will be creating, essentially taking a page from China's playbook and saying, we're going to build more infrastructure, and this will stimulate domestic industries. And so by creating a domestic market, we will cause more manufacturing of all kinds of goods to occur back in the United States. And I think Europe is more disorganized as usual, but they have, I think, similar ideas. So I think what you are going to see is continued engagement of global companies with China, but stronger efforts, particularly by the United States and maybe by Europe, to invest more domestically in things like infrastructure and thereby create markets that suck more manufacturing investment back in as a secondary effect. So is that decoupling? I'm not sure that's decoupling. I think it's sort of everyone trying to do a mini version of what China has been doing for 20 years. And we'll see how successful they are in that.
Okay, that's good. Thank you. Well, there's so many good questions, and yeah, Claudia and Julia trying to put them together here. So let me start with this one. What is the main difference between Chinese state approach in the present from the last 30 years, in which the state had also a crucial role in giving directional signals to private companies, as well as improving access to foreign companies? It is only the area of focus?
Yeah, no, that's a great question. Actually, I was involved in a conference on industrial policy a couple of weeks ago in the U.S., where we debated precisely that question for a couple of hours, like how much of this is new and how much of this is just the same old thing that they've been doing for years. And I think actually I'm going to throw up my slide again to illustrate something here. I think there is something different. This is kind of a timeline of Chinese industrial policy. I think there's a strong argument to be made that up until 2006 or so, the emphasis in China was much more on letting markets do their thing. Yeah, there was still a lot of state involvement, but fundamentally what you saw up until around about that time in the early 2000s was a much more rambunctious market-driven approach. And the state, put out plans, but they didn't really fund the plans very much. They weren't very specific. A lot of companies and localities ignored them. So industrial policy was frankly not that effective, right? This changes in 2006 where they start to take a more long-term view and they identify 16 so-called mega projects of technological development, of which I will, mention one, which is China has this alternative to GPS called Beidou, which is a global positioning, satellite technology. That was initiated in 2006. It's now quite large. And it's a pretty, significant alternative to GPS. And that had its roots in that long-term plan that started in 2006. And so we can say that starting in 2006, they really started to put money into specific state-led projects, which they had not done before. Second, I think the key thing is 2014 with the launch of the National Integrated Circuit Fund. One of the major differences between industrial policy of the past and industrial policy now is the funding. So there were no sort of coordinated or significant funding mechanisms for industrial policy. They had like tax breaks and this kind of thing, some subsidies, but really no coordinated large-scale funding strategy. And the National Integrated Circuit Fund changed that. They raised, in the course of 1 year, they raised $20 billion from various state-owned enterprises and the Ministry of Finance to throw into semiconductors. They did a second round of this Integrated Circuit Fund in 2018, which raised another $30 billion. There were city-level IC funds that raised $5 to $10 billion each. And then we saw this funding mechanism spread into other sectors. And as I said, it's very unclear how much money has actually been raised, but it's probably quite a lot. So I think the single biggest difference between this industrial policy and the previous industrial policy is that it's better funded by orders of magnitude. And the second biggest difference is that the strategic coherence of it is much stronger than the past. It's not just that this industry and that industry, there's really an overall strategic plan that is driving towards specific goals. So yes, I think this is different and I think potentially more problematic for the rest of the world than traditional Chinese industrial policy.
Mm-hmm. Thank you. So related to that, is this new approach of import substitution in high tech going to be less inefficient and less that dependent than the infrastructure lab model?
Yeah, that again, a very good question. I think is it going to be less debt dependent? Well, it should be because the government has a concern about overall leverage, right? So one of the constraints operating on the system is that, from 2008 to 2016, basically, gross debt to GDP went from 140% to say 250%. And then in this past COVID year, it went up to about 270%. Not because debt was growing so fast, but because GDP was very slow. And for several years, the government has made it clear that they don't want that leverage ratio to rise very fast, right? And they have been very, very strict in their financial discipline. And so what that means is that there is now a policy constraint on how much debt can be out there. And the debt needs to show that it's financing something useful, right? And so we'll see. I mean, I think it will be interesting to see over the next 5 years as, Chinese industrial policy gathers steam, who wins? Is it the people who are saying we need to keep the debt ratio under control? Or is it the people saying, well, yeah, but actually we need to raise a lot of debt to fund all of these semiconductor fabs, so let's let the debt ratio go up, right? And again, we don't know who's going to win that. So far, over the last 5 years, the people who've said we want to keep the debt ratio level have been winning, right? So there is a financial constraint. I think this is one of the questions that we can pose, but it's very difficult to answer right now. Is this going to be more efficient than the traditional infrastructure driver? Is it going to be less debt dependent? Hopefully so, but not at all clear. We'll have to see how that goes. And again, I think this is a problem because it gets back to my point about getting rid of the losers, right? So if you have a soft constraint that just allows people to keep borrowing more and more money, even if they're not really making profits, then I don't think that this strategy is going to work, because then the people who should be leaving don't leave, and you just get excess capacity and a very slow rate of innovation. So very good question, and we kind of have to leave it as a question mark, I'm afraid.
Okay, and now there's a participant asking if you could elaborate on the implications of your China scenario for commodity prices.
Yes. Well, so broadly speaking, so if we look at the traditional commodities that have been at play on the infrastructure sector, the outlook there is frankly not bad. I did say that housing and infrastructure, they're now peaking. The demand there will probably decline over the course of the next decade. One thing that we haven't talked about today, because there wasn't enough time, was China's climate goals. So they do have a hard target of capping carbon emissions by 2030. There are several senior people who've now come out in public and say, actually, we should do it earlier, 2028. And they're serious about that. And I think one of the things that is going to show up in very soon, as in now, is tighter restrictions on the steel industry. And I think they're going to be using their carbon targets as an effort to consolidate and somewhat downsize the steel industry. And we are already seeing that right now. Now, does that mean that commodity imports, in this case, iron ore, go down? Not necessarily, because there's still a lot of underlying demand. And as you consolidate the number of players, presumably you give them more pricing power, they become more profitable, they can pay higher costs for inputs, and they may choose to pay a higher price for imported iron ore, which is higher quality than domestic. So even if the overall demand goes down, the import component may stay stable or go up. So I'm actually, from a traditional hard commodity standpoint, I think that the emphasis on China on reducing its carbon footprint and making its energy intensive industries more efficient actually could be, not negative for commodity prices. So I think the secular trends are, potentially favorable for some of the traditional commodities. Then if you look at the other commodities that are, important for the electronics industries, things like copper, tin, and other specialty metals, I think clearly the demand from China is going to go up because of all this investment there. that they're putting in. So it's a mixed picture, but I think China is still going to be quite an important driver of demand and prices across a wide range of commodities for some years to come.
There's more than one actually question about the Belt and Road Initiative. So maybe let's just combine them and ask your views about how do you see the BRI going forward?
Okay, so this is a tricky topic. I guess the first observation I make is that the Belt and Road is it represents something real, but it is also basically an advertising slogan, right? So I'm always a little bit leery about talking about Belt and Road in two specific terms, because essentially that's just a label that the government placed on top of a broader set of activity that is much more amorphous. And it's been a very successful advertising slogan, I have to say. It has really caught on. Observation about the Belt and Road is, okay, if we say what we're talking about here is China's external financing of basically infrastructure projects around the world as a mechanism for building political influence. That's what we're talking about. This is going to continue, but it's going to continue under some significant constraints. So if you look at the main indicators of what you could call Belt and Road activity, Chinese outward direct investment has been going down for the last 5 years. Chinese overseas lending peaked about a year and a half ago and has been kind of on a plateau since then. And if you look at the revenues of Chinese engineering companies from international projects, they peaked about 3 years ago and have been stable, right? So a lot of the physical indicators, the metrics that we look at to measure so-called BRI activity, they've actually peaked or are going down, right? So I think we are done with the growth stage of China's, international activities, BRI, if you will. And there are some of the reasons for this is that a lot of these projects didn't work out. They did not deliver good financial return, or there was political blowback, there was corruption involved. So a lot of the problems with BRI have started to bubble up, and the Chinese are trying to figure out how to deal with them. So I think what we're looking at is a recalibration of China's efforts, and probably not much growth in the annual funding for these projects in the future, but more of a steady state where every year they're lending, a couple $100 billion, something like that, to these projects, and they come under increasing pressure to make these projects really economically viable. So that's, I think, the observation there. I think the second interesting question is how much other countries choose to get in the game. So United States under Trump had something called the Build Act, which put $60 billion towards international infrastructure development. I think the US in particular is beginning to wake up to the fact that, if they don't want China to be building influence through the BRI, then the US has to have an alternative. Mm-hmm. And so what you may also start to see is that there are competing efforts by the US and maybe Europe to build infrastructure, and that again imposes some kind of constraint on China's ability to build influence through this program.
Excellent. There are more than one actually a question related to the digital yuan. So maybe if you can share your views about the digital yuan going forward.
Yeah. So China has been in the forefront of what we call central bank digital currencies, and I think the main short-term objective is just to increase efficiency in the domestic payment system, right? So this is really focused on how do we make payments smoother within the Chinese context. And it's still very experimental, and there's still a little bit of an issue that needs to be resolved. There are already digital payment mechanisms in China that work quite well. So I have them on my phone, WeChat Pay, you must have them on your phone too, Alipay. It's been around for years. They're private sector. They're very useful. Everyone has them. And so the concern of these operators is, okay, is the central bank now going to be offering essentially a competing service for free? And is this going to drive WeChat Pay and Alipay out of business? And the central bank has, thus far, it's been pretty careful to say, no, 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 that's not what we're doing. This is kind of an alternative. It's more kind of like a, just a sort of a convenience. We're not trying to get in the way of the private sector actors, but I think that is something that is going to have to be sorted out. That's by no means clear. I think the broader question that people have is the digital currency the start of a campaign to create a payment system that is separate from the US dollar payment system? And clearly that would be a long-term objective of the Chinese government. They do not like the fact that they don't like that they're dependent on US technology, and they don't like the fact that they're dependent on the US dollar payment system, because that puts them at risk of, sanctions basically by the US government. Problem is that there's no real alternative. And I don't really see that in the short term that a digital currency solves that problem, because ultimately, even if you have a digital currency, payments have to go through banks. And if you're paying for, international commodities or trade transactions, a lot of that is still denominated in dollars. So having a digital currency doesn't really solve that problem. And it doesn't solve the underlying problem that in order for the renminbi to become a more serious alternative to the US dollar, people need to be able to be comfortable holding large balances of renminbi and investing them in the Chinese capital markets in the same way that they invest in the US Treasury market. And right now they're not willing to do that because China has capital controls. And so you put your money into the Chinese capital market. Can you take it out when you want it? The answer is you don't know for sure. And if you don't know for sure, then you're not going to put your money in the first place. So this has been a real obstacle. And as long as China has capital controls, I find it a little, and I think they're going to have capital controls forever, basically. Then I find it a little difficult to understand how the digital currency solves that problem and creates a real alternative. So I think it's an interesting experiment. I think we need to watch it very closely. I don't think that the practical significance of it on the next, say, 5 years is going to be all that great.
Thank you. Do we still have time for a question, or Julia, how do you,
Maybe you make your last question, then we...
Good, Arthur, if that's okay with you, sure. Here it is. So it relates to COVID vaccination. So COVID vaccination program in China is at a slow pace as compared to other countries. Well, I got my shot here, so
my shot here also.
Yeah. This implies that China is not reopening its borders. How would this affect the Chinese economy, if at all? Right. Is the vaccination policy going to change? How do you see this?
Yeah, well, so the first thing is that the Chinese economy has done extremely well with closed borders. Because if you think about it, it's a large domestic market, and the key thing is they don't have COVID, so people can do whatever they want. The domestic economy is fine. So the other big thing is exports. Exports have been completely unaffected. In fact, Chinese exports have outperformed global exports by about 10 percentage points. So again, COVID doesn't affect exports. It doesn't affect the domestic economy. It just affects the ability of people like me to come and go the way we used to. And that's not very important. So I think that China is perfectly capable of running a pretty vibrant economy without opening its borders, right? However, yes, the vaccination policy is changing rapidly, and the government has started to indicate an intention that they really want to get the majority of people vaccinated, and some people are talking about even doing it by the end of this year, which would be an extraordinary accomplishment in a country this size. I don't think they'll quite make it, but my sense is that there is a recognition that keeping the borders completely closed the way they have is ultimately going to create some political costs that they would rather not bear. So they need to move in a direction where they can open things up and reduce some of these political costs. They also have the Olympics next year to think about. So they're hosting the Winter Olympics next February, and they need to have a mechanism by which at least the athletes can come. and maybe some spectators, although I think there's a good chance that they'll just limit it to domestic spectators. But again, as you get closer to the Olympics, I think it's important for them to show that they have at least somewhat open borders. Otherwise, I mean, the Olympics are already, I think, going to be politically fraught because of, the human rights concerns over Xinjiang and Hong Kong. There's talk of boycotts, et cetera. I think they want to make that whole thing as smooth as possible, and having some degree of open borders will be important to that. So yeah, I think we are seeing a shift towards a much more intense focus on domestic vaccination, and I am cautiously hopeful that at some point later this year we'll start to get some reciprocal agreements between China and other countries where each side recognizes the other's vaccines, and that enables freer travel. It's a problem because the Chinese have not released data on the effectiveness of their vaccines. So politically, if you're sitting in the United States, well, we have 2 vaccines that now have proven real-world efficacy of over 90%, Pfizer and Moderna, and Chinese vaccines of who knows how well they work. Can President Biden say, oh yeah, we accept their vaccines as the equal of ours, therefore two-way travel will resume? I think that's very difficult politically to handle. But I think this is rising up on the agenda of not just the US and China, but a lot of countries, is to how to enable international borders to reopen. And it really comes down to vaccinating as many people as possible and creating a mechanism for mutual recognition of vaccines and some kind of a digital certificate or passport for vaccination. I think we will get there at some point this year, but it will be a very difficult negotiation.
Well, thank you so much. Maybe I think over to you, Julia. Thank you.
Yeah,
thank
you, Arthur. Thank you so much for being here with us today. I received many positive comments on your presentation here in WhatsApp and Q&A, so people are very happy to listen to you. And thank you very much to Cláudia Trevisan, CEBRI-CEBC, Ambassador Castro Neves to co-host the event, and Tatiana to join us from China at late hour now. So thank you, Tatiana, to be here. And I'll pass now to Ambassador for his closing.
Well, I would like to join Julia, thanking you very much, Arthur, for a splendid presentation, and also Tatiana for a most able conducting of the debate of the question and answer session. It did give us a more precise vision of China's present moment. I would, if I may, just add a reference to the meeting that the US and Chinese authorities had in Anchorage in Alaska. My perception was that they were playing, both delegations were playing for their own internal constituencies rather than negotiating anything. But I think that situation may, as you implied in your presentation, the moving from constructive engagement to a strategic competition, the strategic competition will be somewhat modified or conditioned to new opportunities and challenges that both countries will face. Right. But they are both aware of the importance of their relationship for the peace and international peace and security. And I remember once when I was in Beijing, young Jeshi was saying to our vice president at the time that he considers the first priority of China in international terms having good relations with the United States of America. And he said, you know, Mr. Vice President, our relationship, US and China, on our relationship depends on international peace and security. And that is our top priority. Yep. And I think it still is their top priority. And well, finally, I would thank all of you once again, and even those who are viewing our meeting. And I would also, again, thank our sponsors, Susano and Bayer. And I think that both in CEBRI and CEBC, Arthur's presentation will be there for those who want to download the entire text. Thank you very much to all of you. And it's indeed a pleasure for me to be here in this joint venture with CEBRI and Brazil-China Business Council. Thank you.
Well, and thank you very much all for this terrific event, and I hope we can do it another one of these in person in Brazil next year.
Yeah, definitely. Next year. To see you, Arthur.
Okay.
Bye-bye. Take care.
Thank you very much.
Bye, Tatiana.
Thank you. Thank you very much.
Obrigada a todos vocês. Até a próxima.